All right, so we have a nice amount of people on here, so we're going to get started. We have Barry Habib, President and CEO of MBS Highway. We were just talking a little bit before we got on here about current market conditions. So I wanted to provide, obviously, a market update. On Friday, we're going to be doing a Facebook Live. We have Dave Stevens. Tell everybody about the Facebook Live you were.
All of these interviews providing so much information. It's thank goodness for you, brother. And
same to you. I can't believe how many you do. It's really amazing.
Well, thanks, man. And everybody that's watching, just want to hope you and your families are healthy and safe. We know that one of the biggest challenges facing us right now is this forbearance issue and servicers, and it's a big challenge and it's a big issue and it's a dangerous one. And there's a fix for FHA with the pass-through facility that's been created, but there has not been one for Fannie and Freddie transactions, which represent so much. So someone who's been extraordinarily vocal is a friend of mine, is Chris Whalen. You may have read the articles. Anthony, I know you kind of posted one of his.
Yeah, it's a great article.
Right, and he was really terrific. And Chris is brilliant. Okay, he's a real straight shooter, which I love. You know, he just lets it fly, but he's also extraordinarily well thought when he makes his comments. And thought maybe it would be great. Chris and I have had many dinners together. Always respected him, and I think he'd be extremely insightful for us. And then Anthony, I wanted you there with us too because you've spoken to Mark Calabria, and you have been a leader in this fight as well. And then, of course, David Stevens, who is just a prince and wonderful, who wanted to be on as the NBA president, Bob Brooksmith, but Bob Brooksmith wanted to come on, but we just couldn't get the timing for him right. So we're going to try and do something with him as well. But I think this call will be really awesome. We'll do a Facebook Live similar to kind of something we're doing here. And I think it'll be really insightful. We'll take questions from people because this is right now the most important thing going on, is to try and find a way to fix this with the mounting amount of forbearance and first payment defaults that are about to happen.
Yeah, I agree. And honestly, it's funny because Chris Whalen, Chris Whalen and Dave Stevens are both in a unique position that, they are not, they can speak freely and be very honest because they don't have, Dave's not running NBA anymore. Chris has currently got his consulting business, but he's not, sitting in the sea of somebody's capital markets. And they've been very vocal and very direct. And it's kind of, they're saying everything that everybody's thinking. So it's going to be a good discussion. Is that going to be on your Facebook?
Yeah, we're going to do it on the MBS Highway platform. But you know what? This is bigger than us, Anthony. We're going to make it just public for everybody because everybody should be seeing this. We know and our subscribers understand that a lot of times we do put content for them, but this issue is an industry issue that's really critical. So we just want everybody to have it and be able to help the community at large, and all of us will have the opportunity to ask questions to them as well.
So that's going to be Friday at.
So that is going to be Friday. I want to say at 1 o'clock. I should have known that, right? But take a quick look, Anthony. It is Friday at 1 p.m. Eastern time. So
all right, we're going to share that. We posted on the AIME social media page, guys, yesterday. I'm going to share that in the group after this call, but be sure to tune in for that. I think that's going to be very, very, very high value. So looking forward to that. Thanks for organizing and thanks for letting us participate. So Barry, tell us, the market this week, what are you seeing?
I love the steady hand by the Fed. I love that since we were able to get in front of them and explain to them what they were doing, they're still buying mortgage-backed securities, but they've really throttled it down. The first thing they did was they throttled it down to a much more manageable level. But if you notice, for the last 2.5 weeks, it has been almost a flat line. Yeah, we had a little bit of a move up, a little bit of a move down, but nowhere near the turbulence we were experiencing. The Fed's been wonderful. They've been precise. They've been surgical in their purchases. Now, what is interesting is they are definitely making purchases at a much smaller degree. And I want to watch the market specifically today after 1:30 p.m. because the Fed will now step out. They were doing later in the afternoon purchases as well. So I think this is going to be a test to see how does the mortgage market behave with the training wheels off in the afternoon. So I want people to just be cognizant that there could be a little bit of volatility in the afternoon. It'll be interesting to see how the market survives on its own without the Fed there to steady it. And when the Fed eventually does step away, we're all going to have to be aware that we're going to be in for some potential swings in the marketplace without the Fed there to steady us.
When and how, like from a standpoint of that situation, is that going to be an announced situation where the Fed identifies they're going to be leaving the market, or is that abrupt?
It is. They are very transparent. To their credit, they're very transparent. So we get the data, we pass along the data, and it's something that we know in advance what they'll be purchasing. They don't go way out in advance and tell us, but they will tell us, for that week what they're looking to do. So we're able to kind of get a feel or an idea. And then they'll also, as you get closer, announce daily, what times that they will be doing some intervention in the market, what they call operations in the market. So that's important. So it brings up a very interesting point maybe to talk about, Anthony, because so many people are worrying or thinking, what happens when the Fed steps away? What happens to interest rates? What can we foresee in the interest rate environment? Do we look at interest rates going up? Should they go down? And I think that's a very interesting discussion for us. So maybe we should talk about that for a little bit.
Yeah, please, yeah, that's actually interesting. So because that's been a big topic, and I've seen a lot of social posts in the last 2 days about this, is people kind of posting, get ready for rates to go down. What are your thoughts on as the Fed adjusts?
So we're going to be in for some turbulence. Okay, when the Fed steps away, there's going to be turbulence. Now, fundamentally, rates should be pressured lower. That's fundamental. But in the interim, I want everybody to understand that if we see the stock market make a move lower, there's going to be some liquidations that go on, and REITs are going to be liquidating and putting supply on the market. You're going to see funds liquidating to put supply on the market. So you could be in a bit of a turbulent situation, and without the Fed there steadying it, we could see some moves to the downside. But remember, I said fundamentally rates should remain good. Why? Well, listen, as far as the Fed funds rate, while it doesn't directly impact mortgages, the Fed will keep rates low for many years. Remember, after the crisis, the financial crisis and the housing bubble, the Fed kept rates at 0 for 7 years.
Yep. This
is worse than that. So I expect many years of a 0% Fed funds rate. So there won't be any upside pressure on the short end. As far as the longer side goes, that's dominated by inflation. Are we going to have any inflationary pressure? I don't believe so. And the other thing that really fundamentally drives interest rates lower, and this is something that we have to kind of get our arms around fundamentally, and this is what happens when a country has a lot of debt. And initially, many people would think, well, all this debt could be inflationary, right? It's so funny, but it's exactly the opposite. Everywhere in the world, everywhere in history, the more debt a country has, the more interest rates are pressured lower. And we are certainly getting ourselves in a lot of debt, aren't we? That has to be repaid, and we will be in a position where for the foreseeable future, one of the fundamental circumstances we will see is that in a more balanced environment, there will be a lot of downside pressure on interest rates. So, I think that to see rates for the most part below 4 is to be expected. And when you think about that, perhaps makes $5 trillion or $6 trillion of the mortgage market in the money to refinance. Well, we're going to be busy for a long, long time, Anthony, on that end. And I think purchases do come back. They climb out a little slowly, but we're going to be on both fronts doing a lot of work and a lot of business. But there will be some changes, though.
Yeah, absolutely. So just to give everybody kind of a summary of that, what I'm hearing is short term, as the Fed starts to ease out of the market or completely back out of the market, expect turbulence. That's not what the fundamentals are indicating, but realistically, when it comes to locking, you're going to want to keep an eye on locking loans as they come in. Long term, the fundamentals indicate that we're looking at very, very low rates for an extended period of time.
Yes, absolutely. Now, there's one fly in the ointment here, and let's talk about that before, if you'd like to, we could discuss what some of the changes that could be expected are. The one fly in the ointment, and Anthony, you and I talked about this together, and we kind of had a very, interesting talk, because for both of us, we were a little concerned about what happened last Friday when the Bank of England took a step that is kind of like crossing the Rubicon, where what they did was they actually began money printing. And that's very different than what we're doing here in the US, where while we're getting into debt, there's a corresponding ledger item where it's either on the Fed's balance sheet or it's money that's owed, or we're selling treasuries to do so. So there is debt service, and that's what creates that downward pressure. But money printing, I guess the best analogy is kind of like a magic credit card.
Yep.
that you take this magic credit card and you say, oh, spend what you want, pay off whatever you want, and you don't have to make any payments ever. You don't have to pay it back. It's just poof. It's magical credit card that's out there. Boy, as you know, I'm a big historian, and I love history, and I studied. I've studied all of the periods where you get something called hyperinflation, and I'm not suggesting that this happens here, but we do have a major economy that has began money printing. Now they say that it's going to be limited. They say that there are intentions to pay it back, but you know, Anthony, this is the type of thing that it's like people say, well, boy, we can make a lot of bad stuff go away. Maybe we'll just do a little bit, or maybe we'll do a little bit more. And then how about Japan, who has tried everything and has just been mired in debt, the #1 debt to GDP in the world, 220% debt to GDP. The United States is not great at 110%. But what if Japan did it too? Okay, well, now you got the UK, now you got Japan. Does the United States get tempted to wipe out some of this debt by doing it? I pray and I hope not. And I hope cooler heads and smarter heads prevail. But if you were to say, what is the biggest fear that you have? I think we come out of this coronavirus with some bumps and bruises for sure. And I feel terrible for the economy. And of course, not to minimize the unbelievable, how can you even talk about the loss of life and what's gone on? I mean, that's the worst thing. But economically, when I say bumps and bruises, we're definitely going to get knocked around, but we will start to come back. It won't be that fast, but we will come back. I think anybody who thinks we're going to be in a V-shaped recovery is perhaps a little bit overly optimistic. So we know that there's going to be a stage that's an unlockdown stage, and then we'll get into, after a vaccine, a period of growth, but we're still going to have prolonged levels of unemployment, maybe reaching 7% or something like that. Not terrible, but 3.5%. So there'll be some strains on us. However, I think we're going to be okay. If we get into money printing, that's the one thing that worries me. That worries me a lot. And I don't think we will. I pray we don't, but that's the one thing that bothers me.
And you kind of we talked on Saturday night about this, and you had talked about like the importance of the gold standard and being gold because of the fact that, you know, if people start printing money, then it's devaluing their currency essentially. Yeah.
Yeah. I mean, you know, there's going to be a lot of finger pointing when this is done, you know. I wonder how our relationship is going to be with China after this, because there is a lot of people that are very angry with the Chinese Communist government, because how can you not be upset with the loss of life, with what's happened? I mean, this is something that, you know, when you think about it, Anthony, when you look at the facts, what's really, really upsetting, and upsetting is a kind word, is you think about the fact that this thing was running around for, what, 6 weeks in Wuhan?
Yeah.
They covered it up. Why? Because they wanted to get the trade deal done. And if you look at the trade deal, there's an out clause in it. The out clause says that they don't have to live up to their obligation. Get this, Anthony, this is what's written. If there's an act of God, if there is a pandemic, okay, think about that. Sign a deal. Within a week of signing the deal, then they disclose that this thing is out there.
It's crazy.
It's very unsettling, to say the least. But there are better things for us to talk about, right?
Yeah, totally. So you were talking. We were starting to talk about a little bit about the changes that are coming. You want to get into that a little bit about what changes we can expect?
So prepare yourself, because I think the mortgage market's going to be great. And I think that the purchase market will come back and provide opportunities. However, I want you to understand that it's going to look a little bit differently. So let's prepare ourselves for this. Think about a few things. The three in particular that I want you to think about is that above par pricing will be more dear. It'll certainly cost more. And I think it won't be uncustomary to go back to doing things like when I started in the business, it was pretty common to see 3 points. I'm not saying that, but I think you might see, if you think about it normally, a 0 point loan to a 1 point loan, it's usually, to our experience, has been about a 0.25% difference. I think you might see maybe a 0.5% difference. So there'll be a greater incentive for somebody to say, I'll pay a point, I'm getting a better deal. And what that does is reduces exposure from the servicer side, because we're always trying to fight the last war, so that their servicing values are repaired more. Now, while that might not be something we love, I think we all will drink from the same well, and I think it will be more widely accepted. Another one that I think people should be thinking about is that you'll more than likely see rate lock periods be more expensive for a longer term rate lock. Why? What was the lesson we learned? The margin calls really jeopardize the solvency of many people. And I think as a precautionary measure into the future, try and make it so that if you want to go out 60 days, you really got to pony up for that 60 days, because maybe that means you don't have to hedge as immediately. It'll give you a little bit of cushion there so that you don't find yourself upside down with margin calls as often. So be prepared for a change to the lock period. And, you know, just in general, I think there will be some adjustments that you will find change things a little bit, make things a little bit more of an inconvenience. And that's what it's going to be. It's going to be an inconvenience. But the really good news is for a very long period of time, you will be in good shape. The other one I was going to mention, because I said 3, the other one was I think that there might be a longer term period on clawbacks for early payoff. Perhaps instead of what's more customary of 6 months now, that might get extended to a year. So these are things that I can see us being prepared for into the future.
Yeah, so this has been a really big conversation. I actually spent some time this morning talking about it on the future of servicing. It's an interesting dynamic because right now, you know, basically lenders on new loans that they're originating are valuing servicing at 0. And of course, you know, assuming that servicing values, you know, go up in the future, which you would hope, you know, that does happen, then great, then they're going to be in the green. But realistically speaking, this in combination with the prepay issue has really put the dynamic of what is servicing worth back into, you know, the forefront. And I guess the question I have for you is, you know, is that going to, you know, does that have the ability to really impact the structure of A, compensation, but B, the way, like you talked about, like charging points, like, hey, you can't just have a no point deal or a 0 closing cost deal. They're not going to pony up those credits that they used to.
Yeah, I think you will have a no point deal option, but it may be more expensive, a no closing cost deal, which will be more difficult, very challenging to get. And listen, I've been the biggest fan of it. I was the one who brought that to the marketplace back in the early 90s to show my age when, you know, I was going on CNBC when I had my show on there and no one understood what it was or how you could do it. And I was teaching mortgage companies how to do this. So it became kind of like a standard thing to do. But I think that's going to be more and more challenging to see because it's just too costly on the servicing side. And if we want to build back servicing values, which I think will come back, I think it will take time. We have to get through this period of time. We have to get people working again. But as we get into 2021, 2022, servicing values will get back. You know, remember the two sides of the way people transact things, and that's out of fear or out of greed. And right now, there's a lot of fear going on, so people are pulling back, and rightfully so. You want to be more conservative. Right. This is not the time to start taking additional risk. But as we get more stable, everybody's greed desires kick in, and competitive and animal spirits will take over, and you'll see servicing come back. You'll see a lot of these things come back. But the things that I mentioned, I feel will have a much more difficult time, that way above par, where you have the closing costs included. The early payoffs will probably be an issue. You know, so the things that we had discussed, maybe the longer term rate locks become more costly. Those will just be smart business maneuvers that people will make.
Yeah, absolutely. So another question I have for you is, you know, when we think about EPOs, one of the things that I've been, you know, trying to communicate out to this group is, you know, a lot of lenders have come out recently and said, hey, if a loan goes into forbearance before the person makes their first payment or within their first couple payments, you know, they're looking at it as an early payment default, and they're looking at it as potentially recapture of the compensation. So, you know, brokers have come back to me and said, well, borrower goes into forbearance for 6 months, then they get back on track. That lender, you know, they're getting our compensation back, plus, you know, the customer gets back on track, we're getting screwed. But what really is happening is the fact is those loans can't be securitized. So those lenders are in a situation where they're basically having a 100% haircut on that transaction because the loan can't stay on their warehouse line. They have to put in their servicing and they have to pony up their cash.
Anthony, this is what you're doing is you're just speaking like a leader, you know, and that's what we have to understand. We have to understand, all of us need to be looking at this as leaders. Take a step back and just put yourself in the position of a lender, okay? The lender now, every loan that has to sit on their warehouse line because it can't be sold limits their ability to close 2x because you could turn that warehouse line over twice. So you have a loan sitting there. There used to be what's called a scratch and dent market, meaning that you would be able to offload that at a significant loss, but manageable loss. Today, that scratch and dent market, they want to just bleed you dry. So there really almost is none. So that's going to sit on your warehouse line. That's why it's so important that we have some sort of a pass-through facility like we have with FHA that applies to conventional loans. This is a really critical issue that we're having right now. And until then, someone that is closing a transaction that doesn't make their first payment, your investor, your lender, your company, they're screwed. And we have to understand that, we want to be partners with them, right? We want to share in the good times, which also means that, listen, we should only really participate in a deal if there is a deal. That's not a deal. That's a nightmare. So if you were the one going through that nightmare, you probably wouldn't feel good about paying a commission to get that nightmare, right? So we have to just have a little grace and think about this bigger picture right now, because this is about let's survive and get through this so we can enjoy so many good things ahead.
Yeah. So I think, what I've learned, and we had a conversation with FHFA yesterday on this specific topic, and hopefully there's going to be some clarity on the Fannie and Freddie side in the coming weeks on this. That'll hopefully give, IMB some relief. But, essentially the way it works is, just like basically, our lenders have warehouse lines. They fund a loan, and within a period of time, let's just say it's 10 days, they securitize that loan with Fannie or Freddie. However, the way that the rule works today is if between the time the loan funds and the time the loan securitized, the consumer requests a forbearance, that loan is not eligible to be securitized by Fannie or Freddie. So what essentially happens is, that loan that's on their warehouse line, they have to pony up and pay what normally would be, going into their servicing portfolio or normally from the securitization, and pay the whole amount. So now they're putting, let's just say it's a $300,000 loan. Instead of putting up their haircut of, 3% or 4%, or yeah, exactly, 2%, they're putting up 100%. And that's, if they're leveraging every dollar they have in their bank times 15 for, their multiple of how much they can lend, now that $300,000 is dead money and they can't lend out, that multiple anymore. So it has a huge factor. Plus the value of the servicing is zero. So they can't even sell it.
Yeah, the analogy is like playing Russian roulette by closing a conventional loan. It's almost that way, because you close it and you say, okay, please God, make them make their first payment. Whew, okay, because if they don't, it's dangerous, and that's why you see a lot of verifications and affirmations going out by people trying to get that customer and scare out the rats and get them to say, hey, I've not been affected. I've got my job. It's good. And you're getting these VOEs day before closing. It's just an effort to try their best to mitigate this. And this is all in the hands of Mark Calabria right now. And Anthony, it's a terrible analogy, but, I think we unfortunately have all seen there could be an intersection somewhere where we drive by, and that intersection perhaps should have a traffic light there, but it doesn't, because it costs a lot of money to put a traffic light there. And it isn't until there are a couple of bad things that happen on that intersection that they finally do the traffic light. Well, if
that's a really good analogy.
But if you think about it, Anthony, it's the same money that they were spending anyway. Okay, they should have done it. They postponed it, but by them postponing it, what was the real cost? And that's what I hope Mark Calabria understands, is that he's going to have to do this anyway. Okay, yeah. Why wait until there's pain and frustration and loss of potential jobs and families at risk? I mean, this is so bad for him to do this and just thumb his nose. And I think he's, quite frankly, I think he's being a bit naive when he says, well, I only see like 4%. It was like 3.75%, which, by the way, was a 78% rise from the previous week in the amount of forbearance. But here's the thing, is that that's of April 5th. Now, it would be naive for us to think that consumers are so steadfast and responsible and eager beavers that they're going to take care of us day one. No, There will be, people wait. It's human nature. People wait till the last minute to do stuff.
Yeah.
So there will be an exponential increase in these as we go. And by the time that snowball gets so big, it's a less manageable position. The first thing he totally made, I think, a gaffe on was, could you please have just asked for proof of hardship? I mean, could you, why open this up to malfeasance? Why not just say, look, it's for people. By the way, you know what? Forbearance is actually a good thing because people aren't putting their homes on the market. There's no foreclosures. It's helping people. I agree with it in principle, but you got to guarantee the loan anyway.
Right.
Why put the onus on the servicer for you, rules you create on a loan you've got to guarantee, and put the servicer at risk and those customers at risk and those jobs at risk? I mean, it's this, we can go on in this, but clearly this is a problem.
It's a problem. And, you know, I'm trying to be, you know, my conversations with FHFA and Mark Summers, and I had a call with them yesterday, and basically they told me definitively the traffic light's gonna go up. I mean, like, basically that sounds like it's gonna happen fairly soon, but that doesn't change the other issue, which is the facility that Ginnie Mae put in place that allows for you know, servicers to basically have these P&I payments forwarded through this pass-through facility. Their stance was pretty, you know, we're not doing that. If that's going to happen, it's going to come from the Treasury Department. And you know, Steve Mnuchin on Monday had a comment where he basically said same a little bit of the same, which is like, you know, we've been monitoring the situation, but you know, we're not going to bail out or provide a facility for non-bank lenders. So you know, there's a lot of politics that are going on, and I think the tough part and the disconnect is that the truth is the big banks don't actually want to be in mortgage. There's this delusion that like the big banks are like conspiring and they want the business. But if you look at their actions are telling us that they don't actually want to be in mortgage. They're JP Morgan. They just, you know, they cut their lending guidelines down to 700 minimum credit score, 80 maximum LTV, 40% DTI, a lot of overlays. So like, there's this perception that like it's the banks that are trying to get in the market. I actually don't think that's the case. I think that FHFA wants the banks to get in, and the banks are giving them the stiff arm, and they really need to understand that the independent mortgage bankers are not only, you know, our best you know, opportunity, but it's the only one.
And to your exact point, Anthony, after the financial crisis and the housing bubble, it was the independent mortgage bankers that were there to pick up the pieces. You know, the big banks had a little bit to do with the problems that were going on. And it was the independent mortgage bankers that wound up really picking up the pieces and helping to put that back. So it was those brokers and independent mortgage bankers that helped us kind of claw out of that. And those that were servicing in the area really picked up a lot of the mess. Now, today, we're in a situation where, I mean, what would happen if a major servicer just said, okay, uncle, screw you, uncle. You know, the FHFA has to guarantee this anyway. And why go through all the consternation and mess and dysfunction and all those people that are involved in this? Why cause that issue? You have to guarantee it anyway. So you created it. That's like, you know, it's like, Anthony, it's like somebody saying, you know, if someone were to take an innocent person's checkbook and say, hey, I'm just going to write all these checks out, you know, you figure it out later. You know, they're taking the checkbook of the servicer and they're writing it out. Say, yes, someday maybe you get paid back, but yeah, I'm going to guarantee this, and I want you to write the check for it. It's a crazy system.
Yeah, they're talking at both sides of their mouth. It you know, it's unfortunate because on one side they clearly were trying to do what's right for consumers. That was like that was their intention. But as we know, the road to hell is paved with good intentions. So, you know, that subject is hopefully we see some positive light here in the next couple of weeks. Anything else that you're watching in the market? I know we're going to have our conversation on Friday, so we're going to save a bulk of the stuff when we have Dave and Chris Whalen on the call.
Yeah, I've been buying gold. I've been buying gold just in case. I've been buying gold. I don't like this money printing stuff. So I just as a safety, I think it's a smart thing for me to have is some gold in the portfolio. I think that tends to hold up if there's a wide debt, if there's loss of confidence in central banks, and that'll be gold and real estate, two best things in a money printing environment. So, look, I know that what we're talking about right now is, for those of you listening, it can be a little bit frustrating, give you a little bit of heartburn. You, Anthony and I are just trying to kind of tell you what's out and tell you straight so you know. But there's no doubt, and Anthony, I believe that I speak for both of us here when we say that we are extremely, extremely optimistic about the future. All we're trying to do is just navigate through these waters, because the future is so bright. I mean, and I mean that from the heart. I'm telling you that I think that the future for us is really bright. We are so well positioned. The housing market will recover. There's just more demand than supply. The amount of loans that are eligible for refinance, the equity. You know, the average LTV in a home is 53. There's 128 million households, right? And when you take a look at the amount of home ownership, it's about 64% of those. Then you take 40% of homeowners, no mortgage on there, no mortgage. That's wonderful. Wow. Take those with a mortgage, 50 million households. You know what the average LTV is? It's going to be shocking, 53. You know how much the average amount of equity somebody has in a home? 177,000. So we're not like we were in 2008. We're going to have a great housing market going forward, and you could do so much to pull cash out of people's homes. I know sometimes right now it's not easy. I get it. I'm not insensitive. I know that it's a little bumpy right now, but to the extent you can now, and certainly you'll be able to do in the future, there's so much good that you can do. I mean, we are positioned so well. So if you have to deal with a little heartburn, if you have to make some concessions, if you have to put up with a little bit of aggravation now, take a deep breath. I know it's not fun. I know you got everybody tugging on you. I know that these times aren't as easy, and we're all worried about health issues too. But let's just please keep focused on the long term, because it really is bright. So the key for us now is let's get past this, and we will be in such a good position for a long time.
Yeah, and I think the other thing, just a silver lining, is, you know, a lot of people had record first quarters and March. I think overall, you know, again, the kind of the feedback that April, people are going to have a little bit of I mean, of course, a slower month. But you know, to me, it's a silver lining, because everybody in our industry has been running so hard for so long. I mean, we've had a great run here. I mean, you're going back 10 years of low interest rates. It's okay. Like, that's the one thing I try to tell people. It's okay to have a slow April. It's okay to have slow May. We're going to be busy for a very, very long time. Now's the time to kind of get your infrastructure in place, get your systems in place, hire, train, get ready for the other side of this. And I think the people that are doing that, there's going to be a huge opportunity on the other side of this.
Let's drink to that sometime together, brother.
Absolutely. Hopefully soon. All right, Barry. Well, thank you for your time. We appreciate you. The whole Brokers Are Better community, all of our AIME members appreciate you very much. You're the most watched.
I appreciate you guys. I appreciate you guys. You know, you guys have been really, really kind to me, and I appreciate that. So, so I can't wait till we all have a conference together, and we can get together and have a blast again. It gets back to normal, and our biggest problem is how we're going to manage all the business that's out there for us.
I'm looking forward to it. And everybody, Friday at 1 p.m. on MBS Highway's Facebook page, Barry's hosting a really great Facebook Live. Dave Stevens, former MBA president and CEO, Chris Whalen, market expert, Barry Habib, and I'll be joining as well. So we're looking forward to that. 1 p.m. on Friday. We'll be sharing a link shortly. Barry, we appreciate you. Thank you, and have a great day.
God bless you guys.